So the ASX made another record high yesterday before a slight retreat, and there are further predictions of the ASX making 8,000 points, perhaps even more by Christmas.
Yeah, they are, and I think that needs to be evaluated. What I'm saying is it certainly will happen one day in the future. Whether it's the end of this year, though, is probably the big unknown. And why I point that out is that year to date, we're actually up about 11.5% for the ASX. To get to 8,000 points, that's another 10% from where we currently are. Sometimes we also forget when we talk about the index, it's the collection of all of the companies listed in the ASX 200 or on the All Ords across the country as one group. And the bigger they are, obviously, the larger percentage they make of that index. So the example there straight away is CBA. CBA makes up about 8-9% of the ASX 200. For it to do the lifting required to get the ASX that 10% it needs to probably grow by about 15% in, 6 months. It's at record all-time highs or near enough to record all-time highs. And then you've got to put into the consideration what's going on in its sphere. We know housing is absolutely booming and prices are, but supply is obviously falling, and therefore new loans are falling. There's a huge amount of competition in that space. And although they're probably the best at it and doing very, very well, they're certainly not seeing the growth that we saw in 2013 through 15 to really knock it up that 15%. The next two to look at would be BHP and Rio. They are also at or near record all-time highs. They are being significantly positively impacted by iron ore. Also, copper is doing incredibly well for them. But what gives those two commodities that next leg higher to push BHP and Rio also roughly about 10% to help the ASX get that 8,000 points in 6 months? Final point is that don't forget August is earnings season, and earnings will be good, but I'm not sure they're going to be good enough to support the record all-time high prices. And then they go ex-dividend in September. So realistically, it's 3 months to try and get what will be possibly a little bit less than we currently are to that 8,000 points by the end of the year. Looks a very, very hard march.
Yeah, right. So is it a wise move, do you think, Evan, for investors to take on shares when it is at all-time highs?
Good question. And that's actually a perfect question right now, because there are a significant, including my CEO, for example, who's actually putting his money in the market right now at record all-time highs, and a significant amount.
Okay.
Why I highlight that is that although I'm saying that we might have a bit of a flat year, don't forget I said we were up 11%. If you also look at the ASX over an average of time, so let's look at a decent investment period. 10 years is a good, decent investment period. The average movement of the ASX 200 is 6%. So that includes years like last year. You've also go back to 2013, where we had a very volatile year. 2015 and 16 were negative years. Even when you put them all together, it's still 6% per annum. When you then put compounding on top of that, you then have a scenario that even though they've got those gyrations, he's still averaging 6%. And that, therefore, once you compound that, it takes on 6% per annum to double your money takes 12 years. So that's the other way to look at it, is that his money, he's investing for 20 years. He knows that at 6% per annum, his money will double in 12. So that's the other way you've got to remember, is that, yes, you're at record all-time highs, but if you're reinvesting your dividends, you're reinvesting for the long term, and even with the gyrations that happen in the very short term, over the long term, the average shows that it will come to your advantage. And if you're compounding, compound interest is a very simple piece of mathematics, shows that you'll actually return significantly better than anything else you can do.
Okay, that's interesting to know, because, like when COVID hit, there was obviously that huge dip in the share market, and then there's a lot of opportunists out there that thought, well, this isn't going to be around for very long. You've got a lot of companies here that are going to bounce back quickly. So they threw their money into the share market, and a lot of people have done quite well. But those huge gains have now pretty much come to an end, haven't they?
They have, and you'd also argue straight out exactly with that point, is that they are abnormal. So the movements that happened from end of March to the start of April next year to where we are now, they are abnormal. Seeing 29% for basically the bottom to December, and seeing about 37% to where we are right now from that low point in April last year, that is completely abnormal and should not be expected as what you expect. As I said, I go back to the thesis. There will be a negative point. There will be a time where 1 year will be negative, and there is going to be that, whether it's in the next year, 2 years, 3 years' time, I don't know, but it will happen. It's more, if you can look outside of that and think about it from the point of view that we know what the average is, and you're looking at a 20-year time, that average will come home to you. And that's the way to look at it.
Yeah, that's the point of investing in share market, isn't it, though?
Correct. The more time in the market, the better and longer opportunity you have of getting that average. And as I said, the compounding interest that comes with that is what you're after.
Interesting stuff. Evan, appreciate that. Talk to you soon.
Thanks, Pete.